Which dividend ETF is going to help you retire early? We're comparing QYLD and SCHD head to head. The best and the only dividend ETF that I plan to ever own is SCHD. We can see right here since 2013, the total return, which incorporates dividends plus the appreciation of the actual fund itself, for SCHD has been 178%, which has even beaten the S&P 500, which is kind of crazy because dividends are supposed to be more conservative. S&P 500 has been 158, and QYLD has been 62%, which is horrible. And you can see at no time during this entire period, the QYLD is the pink line. Did QYLD ever outperform SCHD? So it hasn't just been lately because QYLD's dropped a lot. The entire time, SCHD has outperformed QYLD. Let's talk about what makes SCHD so special and why it's actually not risky, in my opinion, for myself to own just SCHD as the only dividend ETF that I want to own. First of all, the fund focuses on fundamentals. This is Morningstar and Morningstar's analysis of the process. This fund's focus on fundamentals promotes durable yield as stocks on firm financial footing are well positioned to continue dividend policies. It also allows the fund to tap into the quality factor, which has historically been tied to market-beating performance. The fund's profitability measures like return on invested capital comfortably exceed the Russell 1000 Value Index, its benchmark. Dividend-oriented companies with healthy balance sheets tend to be more insulated from the market's movements, so this fund usually strikes a defensive stance. Then what it does to keep risk low is it weights stock by market cap, and it limits each stock's weight to 4% of the portfolio and each sector's weight to 25%. So this fund is never going to be too overweight in one single stock or in one single sector. It looks for dividend paying stocks. It excludes real estate investment trusts, and then it filters out stocks that fall short on liquidity requirements, or if they have market caps smaller than 500 million or have not paid dividends for at least 10 consecutive years. So stocks that pay dividends tend to outperform the market, and they tend to be healthy companies. One of the reasons that SCHD has been such a strong performer in its total return, which again includes the share price appreciation plus dividends, has been so strong is because it owns a basket of companies. It owns right about 100 stocks, so 99 stocks. 40% of the assets are in the top 10. Its dividend yield is currently 3.73%. It actually has a lower than the market average price to earnings ratio. So you're getting large cap value stocks. These are not risky stocks. And the magic is, again, it owns stocks that are growing their dividends every single year. So its dividend payout grows every single year. You can see from 2012, the payout amount was 80 cents per share, 81 cents per share. In 2021, that has grown to $2.24 a share, meaning from 2012 to 2021, the compound annual growth rate of just the dividends alone has been 12% to 2021. And you can see every single year, the dividend payout has grown. When we look at it from a performance perspective, year to date, it's showing as only down 2.3%, which is crazy. It must have had a great week this last week. Over the last 3 years, it's averaged 14% per year. Over the last 5 years, 13%. And over the last 10 years, 14% per year. This has been a really great 10-year stretch. And you can see in each of the years, it was actually a pretty stable fund, right? I mean, up 11% in 2012, 32% in 2013, 11% in 2014, down just 0.3% in 2015, and it was down about 5% in 2018, and it's only down 2.3% right now. If we go to risk, it gets a below average risk rating and a high return rating, and you can see its worst drawdown has been 21% during COVID, actually from January 1st, 2020 to March 31st, 2020. And to give you an idea of the top 10 holdings, the quality stocks that you're getting, you have Amgen, Merck, IBM, Texas Instruments, Home Depot, Pfizer, Pepsi, Broadcom, Cisco, and BlackRock. Then we'll even go to the next 10 too, just so you get some industrials and even some energy stuff. Coca-Cola, Lockheed Martin, Verizon, Automatic Data Processing, EOG, Altria, 3M, Illinois Toolworks, US Bancorp, and Valero. So again, this has a great spread across different sectors of the economy as well. So with this, let's remember that 14-year average annual 10-year return, right? We're not even going to use that for the long-term calculation. So let's jump over to QYLD. And the first thing we need to cover is that This fund, the price of the fund literally cannot go up, or it can just barely go up. But if you look back over its entire history, the price of the fund is actually down 35%. But the total return is still up 62%. How does that happen? Well, this fund owns stocks in the NASDAQ 100, so mostly tech stocks, and then it sells covered calls on top of those stocks. And what that literally means is that it is just going for dividend yield, and the fund performance, the actual price of the fund, literally cannot go up that much over time. It might go up a little bit here and there, but over time it's going to be flat or down, and your only return, your only hope for a return is from the dividend yield. But the dividend yield actually isn't reliable, and you will get paid more in dividends over a long enough period of time from SCHD because of that dividend growth than from QYLD. And if you don't believe me, this is exactly how. So in 2014, you can see it paid $2.57 a share. In 2021, it pays $2.85 a share. So we talked about growth, right? They had negative 14% growth in dividends in 2015, negative 7%, negative 7%. Then it had a huge 40% growth, okay? Negative 13%, and then 10% and 12%. But still, out of all of that, you're still barely above the dividends you were getting paid out in 2014. And if you can look, remember that CAGR, we had like a 12 or 14% compound annual growth rate from like 2013 to 2021. This only has 1.44%. or 4% or even 6.88%. So you are not getting nearly as much dividend growth in QYLD as you are in SCHD. So now SCHD, you get you get the share price return, but you're also getting dividend growth, which is why even though it pays such a lower dividend, it still crushes QYLD, and it always will over a long enough period of time, in my opinion. The other thing that a lot of people don't talk about QYLD is you have heavy exposure into tech stocks, and so it is actually very risky and very volatile, and you can see that if you look at its performance, right? So year to date, it's down 18% versus SCHD, which is now down something like 2%. But in 2014, 15, 16, 17, it was positive, but just barely positive. Had a great year in 2017. It was negative in 2018, and then positive in 2019, 2020, and 2021. But still, in every single year, SCHD basically outperformed. It might have trailed in a couple of years, but the majority of the years, SCHD still outperforms, and this takes into account total return. And so again, you're owning tech stocks. The PE ratio is much higher. And then you do have some great companies in here. Apple, Microsoft, Amazon, Tesla, Alphabet, Nvidia, Pepsi, and Meta, and then even Costco. But again, back to the total returns, right? Even with this great dividend yield, QYLD is only up 62% since 2013. If you want exposure to tech stocks, just own QQQ and not QYLD. And if you need to eventually sell shares off and generate income, then you could either do that, or you invest in something like QQQ or SCHD, because we're talking about dividends here. And then later on, if you truly wanted to generate more income, say in retirement, you move the money into a higher dividend paying fund. But my approach would honestly be to never own QYLD. And once I get to something like retirement, I would just take out the amount of money that I needed to supplement income and then leave my investments in SCHD or something like that. This is just an imaginary scenario. I'm 30 years away from when I would even want to think about retiring. That to me is a much more logical long-term approach than getting tricked into QYLD by this amazing sounding 13 or 16% dividend yield that's not going to grow, and the share price isn't going to go up. And so let's jump back over to this calculator, and what the heck was I talking about, and what are these numbers? Well, this is what an investment plan could be for somebody over their working career, right? $500 a month. Say you start working at 20 or 21 and you work until 60 or 61. We're doing a 10-year average return, but we have a 3% variance, meaning the bottom line is 7%. And that's about what I'm going to give QYLD, even though I don't think it will even do that well over the long period of time, which it hasn't historically. The middle line is 10%, which is again below SCHD's 10 and 15-year average. But in 31 years at $500 a month, you're going to have over $1 million starting from zero. 13%, you would have almost $2 million in 31 years. And that is what SCHD has returned historically, but there's nothing that says it will. And that was a great few years, right? So I wouldn't bank on that. So in this scenario with 10% returns, you get to $1 million with SCHD at year 31. With QYLD, based on that historical 7% return, which is better than it has done, it would take you an additional 7 years and you get there at year 38, right? Let's say you want to speed retirement up and you don't want to retire, you don't want it to take 40 years, you want it to be quicker. Well, how can you do that? Try to have more income and invest more every month, right? What if you were able to bump that up over time to $1,000 a month? Well, then in the middle scenario, 10%, we went from it taking 31 years to get to that $1 million mark to 24 years. So say you're starting at 21, you're now hitting retirement or your $1 million goal at 45 instead of 51, which is awesome. And with QYLD, that 7%, it would take you an additional 4 to 5 years, right? But then after 40 years, if you're able to do $1,000 a month, you have more money than you could ever imagine or need, right? 5 million if you're at 10% a year, and 2.3 million if you're at 7% a year.